One of the questions I was asked during the survey, on the Forex survey, is when should you ignore a candlestick signal? I mentioned this before. When it's a bad risk reward. I don't think ignore is the right word. When should you not trade on the candlestick signal? Ignore it means you completely forget about it. But you saw with many of these candlestick signals, right? If you had like that evening star and it's a bad risk reward, don't ignore it. Just don't use it for the trade at that time. Make it as a resistance area. It's probably one of the most important things that you're going to do to improve your trading profitability by always looking at the risk reward. Okay, how many of you have done that when you looked at the candlestick signal, thinking about looking at what your stop level is and what your profit potential is? How many? See? How many will now? You all had better raise your hand, because that is really going to separate you from the competition, really and truly. And I think just knowing that will pay for this workshop many, many times over. If it's a bad risk reward, you don't do the trade. Okay? And I found this optical illusion here. This is pretty neat. Let's see if this works. Now you see them all moving around. Does that work on here? Yeah. See it all shifting around, all like psychedelic. But they're really not. Okay, I'm going to put this line here. Just focus on one of them. Just one of these little peanuts or whatever they are. You can see it doesn't move. It stops moving. Okay. The idea of this is know what to focus on. Always, always focus on the risk reward. Okay. And that's one of my trading principles. It's number 4 here, but probably as far as importance is concerned, it should be number 1. You always have to judge the risk reward of a potential trade. Okay, here we have a hammer confirming support. Now, I could tell you that this hammer is great. Look how nicely it worked out. Look how the market rallied after. But in the real world, when we're going to be trading, when you see that hammer, what about the risk reward? Is that a hammer that one should be buying on? No. Because the risk reward, that red line there is the area you think about buying because you need a close. That would be my resistance area. Once again, yours could be different, but this is what I'd be looking at as resistance. So your risk is in the blue vertical line. I'm sorry, your target is the blue vertical line, and your risk is the red hammer. The red arrow, sorry, the red arrow. Does that look like a good risk reward? It looks like you're risking 1-to-1. It looks like almost maybe, 1-to-1. Same thing. Question? I probably wouldn't. The question is, where would I enter? Unfortunately, the market didn't pull back to the hammer. Where might I enter, though? I don't know if we're going to look at this one, but it's actually one where we got in the middle of the lower shadow of that hammer. By looking at an intraday chart, we got a buy signal. You didn't have to wait for the close of the hammer. We'll look at that when we talk about intraday. But what you could do is, we know it's a hammer. We have to wait for what? The close, right? It's not a candlestick signal until it's a close. What happens during the day if the market's pulling back and then starts moving up is you may say to yourself, what candlestick signal is that hammer confirming? It's the white. It doesn't quite wrap around the black. What is that? Piercing pattern. So we know we have a potential support area based on the piercing pattern. And although we don't know it's a hammer until the end of the day, if the market gets near that low, the piercing pattern intraday, and then starts pulling up, you may be buying it then, okay, because it's confirming a support area. But if you're just looking only, if say you work during the day, and you come back at the end of the day and you have the hammer, you wouldn't have done any trade, because it didn't pull back to the hammer for us to buy it again. You missed. That's right. Yeah. Right. Yes, you can buy it with the resistance areas broken, and what I would do is classic Western technicals, when we're in a lateral trading range, a box range, the Japanese call it, is you take whichever way the market breaks out, you take the height of the range. So here it broke out to the upside, and this is 172.40, hard to see. Yeah, 176, so what, about 350 pips? Am I doing that right? So at 350 to 176, my target would be 179.50. Keep in mind, a target doesn't mean that is necessarily where it's going to stop. It's a minimum target. It could get above that. And also, if you're trading with price patterns, and we'll look at price patterns in a couple of minutes for targets, it doesn't mean you let the whole position ride until you get to your target. Nothing wrong with taking profits along the way. Okay, here we have a bullish engulfing pattern, also a hammer. And risk reward, I don't know, it might be 2 to 1. I have to look at the numbers, but you know, it doesn't matter about the numbers here. The idea is I want you to get very used to always thinking about this concept, about if you're placing a trade, where's the stop and where's the potential target. Okay, here we have a morning star, light green. By the way, the arrows here, this is actually, we're in a beta test now of the scanning software. And on the top there, the arrow says morning star. So what I did was I said, okay, find the morning stars in the, I don't know what this is. This might be euro. In the dollar yen. And it highlights it. So you have the green, the green rectangle, may be a little hard to see there. But it just picks out the morning star based on my definition. So the trend was down. Okay, it looks lateral, but the trend was actually down based on how I define trend. And that is proprietary for the software. Now, just because you know it's a morning star, that's only part of the challenge. Now you have the candlestick signal. What do you do with it? Do you buy with it? The answer in this case is no, because of the poor risk reward. So just because if you use a scanning software or you do it on your own, you have a candlestick signal, use that as your first step. The second step is analyze if the risk reward is attractive. In this case, it wouldn't have been. Yes? Yes. Yeah. He's saying, just to be clear, isn't that followed by an evening star? And the answer is yes. Exactly. Now, if you view that as an evening star, which I would, why would you not sell short on that evening star? It's still at a support level, right? I'd wait for it to close under the evening star, and as soon as it closed, actually, it closed under the morning star. As soon as it closed under the morning star, that to me was quite negative, because not only did it close into the morning star, wasn't that morning star confirming a support level? Right? So I would be perfectly comfortable being short there. That's a momentum play, right? We have the morning star. At least that keeps us in from going in from the short side. Where do we go short if we see a morning star? Let it break the support area of the morning star. Okay, let's think about this risk reward. Okay, what do you think? How many like it? Excellent. Yeah, I think it looks great. Yep. I think it looks really good. The hammer support and resistance, I would say, once again, a little hard to see. This is the dollar Canadian, around 125. One of the things we'll look at later is prior support can become resistance. So we may have had a support area over here. So that would be my first potential resistance. I would call this R1. But the much more important resistance would be up here at R2, at that second red line. But even if you view R1 as a conservative, what I'll do sometimes is have a conservative and a more liberal target. Even if you viewed R1 as a conservative target, I think this risk reward looks fine. And if your question, then go ahead.
You won't enter that hammer, right? Because all the next candles, some of them goes below hammer.
Okay, none of the candle signals after the hammer closed under the hammer. They moved under the hammer, but they didn't close under it. I don't think so. I don't think any can.
To the right.
Oh yeah, I see.
Okay. It didn't close under the hammer. It moved under it, but it didn't close under the hammer. And in fact, if you were a little bit more nervous about buying in the hammer, which is perfectly fine, because although it's a hammer, is it a new low close for the move on that hammer? Isn't that a new low close for that move? Right? So we'd say to ourselves, okay, maybe we'll buy on the hammer, but nothing says we have to be fully in the position. 25, 50%. And then as the market is building a base there,